It's time now for our Muni moment. As we get ready to hear from Jerome Powell in Jackson Hole this week, we're going to focus on the Fed's impact on municipalities. Vincent Reinhart, chief macroeconomist and strategist at Dreyfus and Mellon, weighed in yesterday on Bloomberg.
States and localities also got fiscal transfers, and they have a cash pile on the sideline as well. And those state governments and localities in particular are the ones that are really very cyclically sensitive.
Joining us now is Chip Hughey, Managing Director of Fixed Income at Truist. You think about what Vince Reinhart had said, and then earlier this morning we also had Evercore's Ralph Schlosstein speaking about how the economy might be a little masked here by how much stimulus we had. What does that mean for state and local governments in terms of the money that they're still operating on that is frankly old money at this point?
Yeah, Scarlet, Sonali, thank you very much for having me. So we saw about $350 billion go out from the federal government to states, municipalities in general. And so that has created a cushion headed into probably slower economic activity as we get into the back half of this year and early next year. So there is that cushion, but it has dwindled. But that is a nice surplus to have and does put a lot of investment-grade municipalities in a better position to ride out potentially slower activity.
I'm curious about performance, price action. When you look at what's happened since early May, and this is something you pointed out to us, U.S. Treasury yields have risen about 100 basis points, of course. 10-year AAA muni yields have risen just 50 basis points. We know that the Fed and other macro considerations drive both the Treasury market and the muni market, yet the move in munis is not in proportion keeping up with Treasuries. Why is that?
Yeah, I think that really boils down to a few things, but the primary driver there is supply. We've seen issuers stay on the sidelines for quite some time. Borrowing costs are very high. We've had a lot of rate uncertainty as a result of the Fed and inflation, and so supply is really low. It's about 14% below what we saw this time last year. It's the slowest pace of issuance that we've seen since 2018, and so because there is just less supply there is a fight over getting access to new municipals. And so what that means is that we've seen as U.S. Treasury yields have risen, municipals have not followed it to near the extent that we've seen Treasury yields move higher. That's probably going to be true if we see yields begin to fall, as we see today is a perfect example, I think, where 10-year down 11, 12 basis points, and AAA municipal market is effectively unchanged. So that creates a smoother ride, less volatility, which is a benefit from a diversification standpoint, but supply is really driving that stability.
And the big story of the year here, Chip, is that ratings change, and they can change quite quickly. They certainly have for the United States government. And I'm wondering if you look at other munis that could be vulnerable, what are you most concerned about, even if it's just falling out of that AAA category?
Right. I think you probably see a little bit of an effect, but not much in the municipal market as a result of the U.S. downgrade. You probably you may see a bit of an effect on pre-refunded bonds, which are largely rated off of the U.S. government sovereign rating, and you also may see it in some housing bonds that are backed by areas like Fannie Mae and Freddie, those agencies. So I think the impact is limited. I don't think there's a great concern about the U.S. government's ability to meet its debt obligations, but I do think that there may be a slight acknowledgement, maybe a relative widening in spreads there. But I think that overall that impact is going to be relatively muted.